Today on the show, we're going to run through some common investment questions we're getting from clients as we head into the end of the year. We've got the election coming up and a lot of questions about the economy and some of the basics too, so stay tuned. Welcome back, everybody, to the MedTech Wealth Advisor Show, the show dedicated to helping professionals in the medtech industry make smarter decisions with their money. We discuss a wide range of personal finance topics like retirement planning and equity compensation and investments. And it's all with the goal to help you save money, pay less in taxes, try to align your capital with your values. I'm your host, Matt Nelson. I'm a senior advisor here at the Perspective 6 Group. If you want to learn more about the firm, just check out our website at perspective6group.com. Today, I'm joined by my partner, Matt Finley. He's also a senior advisor here on the team, and he's been on the show before. He dedicates a lot of his time to the investment side of the portfolios, managing our portfolios and that kind of work. It's always good to have you on the show, Matt.
Thanks for having me back on.
Yeah, absolutely. Some of our most listens when you come on, they're more interested in you than me, I think.
or am I more controversial?
That could be. Since it's been a minute, I think before we jump into our topic, we should just get an update on, from you on the Finley family. It's, regular listeners of the show and definitely our clients know that you have a budding pro golfer in your midst. And I wanted to find out, I actually haven't heard how the summer tournaments are going and what's happening with the, what I understand, the Finley de facto college savings plan.
Yeah, there you go. Obviously I have 3 kids. Oldest is going to be a senior in college this year. Crazy. My middle one daughter is a senior in high school. Well, I'll mention the golf here. And my youngest is a freshman in high school now, which is mind blowing to me. So I won't say my age, but
yeah. How's it been going for her?
So, but yeah, summer's always the busy year for junior golfers. Lots of tournaments all around the country. Lots of challenges, lots of victories, things like that. But the big thing with her age group is what are they going to do next? And while you mentioned pro golfer, obviously that's her dream. But next step is the collegiate golf. So she has committed to play at the top 50 program at the University of Minnesota.
Very nice.
Which is excellent. She had a lot of opportunities at some fantastic schools around the country, and that one just felt great to her. So 4-year full ride. That's the college savings plan. Worked out pretty good.
It's working out. That's very good. The dedication is paying off. Good for her. That's good for all of you.
She's tickled pink, so of course my pocketbook is too.
Yeah, exactly. It's not one of our specific college saving strategies here at Perspective 6 Group, but it works. Like we'll give that one to you.
Exactly.
Well, so in the past episodes, Jacob and I have covered a lot of really financial planning heavy topics, and I was thinking as we come into the end of the year, it'd be a good time to just talk about some investment related questions we're getting from clients. So as I mentioned, there's a lot on their mind. Election is coming up, a lot of economic pieces that are up in the air. Interest rates are changing, just all of that. There's no way we're going to be able to get into all that, but we just pulled, 3 or 4 questions we're getting kind of commonly. And we'll just have a chat about it. We didn't even prepare that much for this line for line. We just wanted to answer how we would if this came to us in a client meeting. So
sounds good to me.
Yeah, I think this will be good. So this one's kind of basic, but I think it maybe speaks a little bit to interest rates and just not knowing what to do with their money right now. But we've gotten this question. So my CD is maturing. Is it a good idea to let the bank roll it over into a new one? Well, okay. Maybe we need to start with what is a CD first of all. You want to answer that?
Yeah, sure. I mean, real simple. Certificate of deposit. Usually can get those through your banking institution or credit union. All you're doing is giving them whatever capital for a predefined length of time and a a rate back. So it might be 6 months, 7 month, all the way out to usually 5 years is the longest we see. Sometimes you can see a little longer. And right now, with the Federal Reserve is going to start reducing rates. It looks like in the next few weeks here. So we're going off of historical high rates of about 5.25 on the Fed Reserve rate, which impacts all of our rate structure in the country. And that's starting to come down. So yeah, there is an opportunity to lock in a higher rate as rates are dropping. Opposite of 2022, right, where rates were going up and CD rates were maybe 0.5%. So that's kind of what CDs are in the marketplace, and you get them through your financial institution, the bank or credit union.
Right. I mean, some other similar instruments might be, fixed annuities from insurance companies, or maybe U.S. Treasury bills, something like that. That's got some guarantee element to it. So it's a great question, and there's a lot to unpack there. But one of the first things we'd have to answer is, what's your liquidity needs? So do you need the money? I mean, this presumably that this question didn't really give us a lot of details when it came in, but is more, let's just have the assumption that none of this money is needed at the moment. Well, then the next question is really, well, how much safety are you really looking for? And not just looking for, could be you think you need a certain level of safety, but what you really need is different from your portfolio level. So once you understand whether you need the money, how long it will be till you need it, and how much safety you really have to have, then you can start tackling that question of, okay, regardless of interest rates, is a CD even the right instrument? What would be some other options we would have to tackle? Let's say presumably someone wants to minimize their interest rate risk, have a good amount of safety, and they're not sure what's going to happen with the money in the next 2 or 3 years.
Yeah, so I would lean into probably directly a treasury bond, right? We can lock in the rate on the day that we purchase, and that is guaranteed as a United States Treasury for the term, as long as the intent is to hold to the end of the term. So if we can lock in 4.8% on a 2-year Treasury, we know on that date, 2 years, they're going to get 4.8% times, the 2 years that they held it without risk, right? And that's really the safest investment in the world. Other vehicles would be, we have access to institutional money market funds, and currently money markets are paying right around 5%, which sounds great, and they are. However, they will slide down a lot faster in moving, the rates ahead. So if Fed drops rates 1% by end of year, let's say, that same Schwab money market fund or other institutions' money market fund is not going to be paying 5 moving forward on January 1. It might be 4 or 4.25. So that's some of the risk there, but it's fully liquid.
Right. Yeah. You trade the liquidity access to it at any day versus
correct.
Maybe interest rates move down. So yeah, a lot to kind of unpack there, but I guess really answering the question, hopefully that helps. This listener is like, should I let it roll over? Well, it a little bit depends on what you're going to do with the money, and depends on, what your idea of the best trade-off is, liquidity versus tying it up for 3 or 4 or 5 years longer.
Yeah, and what the banks are offering right now, I mean, in general, banks will not offer CD rates that we can get in the money market or treasury market. They're always going to be less than that because that's part of their margin, their profitability. So like local banks right now are in the 3 to 3.5% range. Credit unions might be giving you up to 4% on a 2 or 3 year treasury, but they have to watch it too as rates come down and so forth. Their future dollars, they're not going to be able to get as much return. So that's why they're only paying 3 to 3.5 at the moment. So that's where locking in a treasury, if you wanted to stay in that cash market, might be the best option.
Might be a better option.
But again, it depends on some questions that we'd have to ask this specific client.
Very good. Well, okay, so let's kind of address this next one. I think it's got some It's related a little bit to interest rates as well, but the question is, should I pay cash or use a loan to buy my home right now?
We've had plenty of those questions, right?
Oh yeah, a lot of them are coming up. I mean, there's a lot to unpack there again because it involves assumptions about the real estate market, where that's going, assumptions about what else you could do with the cash. Should you invest that? Assumptions about interest rates and loans. So there's a lot there. I'll tackle the first part, just kind of financial planning related. Again, thinking about liquidity needs and taxes. So, presumably this question is coming from, hey, I've got cash available and I could use it, or I could invest it. Well, that becomes now, there's no tax question. That's easier. But you would have to decide whether you want to give up the liquidity. If you just trade the cash to buy the home and now you have an emergency, you've got no cash to use. So let's decide if you have enough emergency fund on hand. If the money, in fact, is sitting in some other type of account where you'd have to pay taxes to get at it to use to buy the home, well, that's a whole different set of analysis, because now it's not just an investment question. Now it's, how much of this are we giving up for taxes first? What would you say about, maybe address kind of the interest rate / our expectation for investments in relation to this question?
That's a big part of the equation if people are getting a mortgage is that the best use of those dollars, right? One of the benefits of having a mortgage on a home is leveraging the bank's money for your gain, right? And you might speak a little more to that, but mortgage rates right now are they've come down to about 6.5%, 6.7% on a 30-year fixed on the national average. So definitely have come down, and with the Fed again reducing rates coming up, they will continue to trickle down. I wouldn't be surprised if they're under 6 by year's end. Does that change the math? Well, that's the exact question. The math is, what are our expectations on that set of money invested, let alone the taxes you mentioned and so forth, versus paying that interest on that loan. Right. So it's a little more maybe a client specific analysis, but in general, if rates are high, it makes sense to pay more cash.
Right.
And if rates are low, it makes more sense to get market, or like we were just saying, treasuries at 5%. If mortgage rates are at 3%, that's a 2% easy spread. Things like that. So it's just understanding the markets. And again, we can't predict the future markets, but we know what history tells us. Real estate averages around 3% annual growth over the long term. Mm-hmm. And, the S&P 500 averages, closer to 9 to 11%, depending on the time frame you're looking at.
Right. Yeah. But in the short terms, you could have huge numbers, in the investment markets. And so
both ways.
So some of it is kind of exactly both ways. Is this house we're discussing just the next 5 years until you have a job change and you change where you're living anyway. So a lot goes into that, but I would say, it comes down to, a couple things. The investment, real estate investors, they're not usually paying cash for their properties. It doesn't work well that way. So one way would be to take a cue from how investment pros work. They're typically going to use the bank's money if they feel like they can get the property at a good enough price. So just apply that to your own situation. Do you really want to use your cash when you could use the bank's cash and do something else with that?
And yet you still benefit from valuation changes over time, not the bank.
100%.
Right? So that's using the leverage of the bank, just like the pros do in their whatever property they're in.
Right. I mean, ultimately it just comes down to what we like to call sort of a regret minimization question here. I mean, neither of us know exactly the direction of the market. We have a pretty good idea that investment markets go up over time. Longer the time frame, the more probability that you should just have your money invested, because it's going to turn out better than the loan to the bank. But in the short term, you could use this cash you have, put it in the investment markets. Next 2 years are mediocre at best and maybe even negative. and you would have been wishing you'd paid down the loan, right? And then you're upset with us, right? And on the other hand, I've seen plenty of times people use way too much of their liquid cash, should have invested it, and markets take off. So some of this question could be philosophical. What's going to make you feel the worst if you get the answer wrong? Hopefully that was clear as mud on that question. I don't know if we need to cover that at some point later, but it kind of relates to this question number 3 we were going to cover, which is, okay, I have a big pile of cash from an inheritance, but I'm not sure what to do next. Probably need a little more color on this. But my assumption, I think, from what this listener's asking is, do I invest it? Like, do I have to save some for taxes? There's a lot of those questions. Again, I'll just address kind of the planning side of it. We would first look at the balance sheet, your personal balance sheet. You got this big pile of cash that's new to you. Are there debt items that need to be paid down first? Kind of like we were talking about earlier. If you've got an auto loan at 3%, well, good for you, first of all, because auto loans are a lot higher than that now. But if you're still holding an auto loan at 3%, maybe you don't need to pay that off. But if you're sitting on a bunch of credit card debt at 16, 17%, yeah, maybe this pile of cash, you pay some of that debt down first. Then we might look at, do you have some current needs or goals that you've been deferring for a while? That small remodel you've been waiting to do. You're going to do it eventually. You might have to take a loan out. This might be the perfect time. Delayed vacations, etc. To some extent, right? So you may use it for some of those deferred needs. And after that, just looking at liquidity for the next few years. So use that sort of frame of reference. How much money will, for debt, things I need now, what will I need in the next maybe 2 to 5 years? But once you understand what you have left over, we like to approach it from, let's get it invested the most tax-friendly way. So we got waterfall things into get your 401k match, get your HSA covered, maybe fund a Roth IRA if you qualify, more back into 401k, and then maybe just regular investment. So that's kind of the planning side of it. But I want you to talk about, Matt, it's still a big pile of cash. Let's say we get to that answer and most of it gets invested. Is this a good time? Like, should they do it over 12 months? Like, how do they do that?
Yeah, that's probably one of the most frequent questions we do get from clients is this a good time for me to put that money into the market? And, data shows us, history shows us that dollar cost averaging when you have lump sums really doesn't work, because you're making an assumption that you know what the market's doing. And while we have a good idea of overall direction, like it doesn't make sense if we're in the middle of a recession and markets are clearly heading down to just put it in at just some random time. But down markets only happen 2 or 3 years out of 10 on average. So on the other 7 or 8 years, it makes sense to invest it. And, I just read an article this last week, and if I can find the link, I will, we can post it here. But it specifically talked about what are the results of investing at peaks of the market. So if somebody does put that, let's say it's $1 million and it happens to be the current high of the market, what does that look like 5, 10, 20 years out? And surprisingly, the difference between that and trying to time other points in the market was extremely marginal over time.
Sure.
And of course, the article was trying to state that don't try to overthink it, get it invested.
Yes. In other words, the odds are, even if you get it completely wrong from a perfect timing standpoint, you invest it at the peak, as long as you have enough time to pass, it's not going to matter. Just generally isn't going to matter. And I'm glad you kind of brought that up, because we've seen in the past clients who just want to continue waiting and waiting. Well, this is around the corner. Well, this tax law is coming out. Well, the election's coming up. Well, this is coming up. And before you know it, we've missed out on, 6, 12, 18 months worth of earnings. It just, yeah. So if you have a big pile of cash, I mean, once you address it from a financial planning, framework, just get it invested. Like, don't wait. Just move on.
Yeah, and I'd interject again, going all the way back to our investment philosophy podcast we did months ago. Like, we are investors. We are not traders, right? So a trader is looking for that ideal time to hold it for a small period and get a whatever potential gain they may have. Investors, we have time on our side and history on our side. It's about time in the market that really will reflect your returns. And so that, again, probably gets back to the question of what's the liquidity need for this inheritance over the rest of your life? Or do you want to maybe even pass it on to your kids or grandkids, start expanding that time frame if that's what it's for?
Yep, absolutely. I think this last question we might have time for here. This one's on everybody's mind, and it probably is on the listener who asked about the inheritance is, well, how is the election going to affect my investments? We've got, unless you've been under a rock, we all have been hearing ad nauseum about a pretty significant election coming up. A lot of news around that, a lot of changes that have happened really just in the last few weeks with this. I think, Matt, we've got an article up that you wrote specifically about this topic in June, and a ton has changed since then. But I want you to speak to your thoughts on that, how we're approaching it, and if listeners really should care or not.
Sure. Will it affect my investments? The answer to that is absolutely it will. Are we concerned about that? The answer is no. And so that's what my article alluded to. And, maybe that's a whole podcast on its own that we could break down and as we get close to the election or something. But the gist of it is history shows that the United States is a growing economy. So as long as we're a growing economy, again, that investing mentality, things will appreciate over time. And it doesn't matter who the president is, who's elected. And we all know every 4 years in our client meetings, depending on what way the election looks like it's going to go, half of our clients think the world's going to go to, and they want to sell everything, and the other half opposite. And, just it's the emotions of it. But the reality is, no matter what party or what candidate is potentially going to get in, the markets are up virtually every time over their term 4 years later. In fact, over the last 100 years, there's only been 3 4-year terms that have been negative.
Wow.
In all presidential elections. And for those that have 2 terms, it's only one of those elections was negative. So the odds are definitely in our favor over the next 4 years. And what's even more interesting about it is, we tend to sell off into an election a little bit, and we may or may not see that a little more this year. But almost every single time, I think all but one, if I remember my data, all but one time has the market not been up over the next 12 months from election day. So again, the odds are in our favor that the markets will be up from November until November next year.
So that, actually it speaks right back to what we were saying earlier is, as long as you have your liquidity needs covered, and that if there's an emergency and you can handle the next 12 months, 18 months, you've got cash on hand, we really shouldn't worry about it. The election pending or not, the odds are that your investment portfolio will be up. But I think the key there is you have to have that cash on hand. That's just smart financial planning.
Right.
And then you should be able to worry less about the portfolio.
And it doesn't mean there won't be changes in the investment structure. Like, certain parties may have things that favor certain sectors of the economy, right? So there might be some adjustments in what works, but not that the overall investments work or not, because history shows us that they will work, right?
Right.
Until it doesn't, I suppose.
Haven't seen it happen yet. I've been doing this long enough to, it's right. No, I think you're right. We could spend a lot of time on this topic, but at the same time, maybe not really. Maybe just leaving it there is right. It does an election matter? Yes, ultimately, there are key decisions that are made for the country, but should it affect your investment, your short-term investment decisions? Probably not.
Yeah, an easy analogy I usually use is Apple still going to sell an iPhone if Kamala Harris is president or Donald Trump is president? The answer is both, and therefore Apple's still going to have revenue and profits.
Right.
The amount of revenue and profits are dictated by other forces and rarely by presidential candidates. In fact, what presidents say they want to do is always different than what gets passed through Congress anyhow.
That's right.
So there's a lot of checks and balances and measures in there, but Apple's still going to sell regardless.
Right.
So that's
right.
the markets.
That's right. Markets only care about knowing what the rules are. They don't necessarily care who's in office. So, yeah, very good. Well, I think that's, we knocked out 4 of them today. We've got other listener questions and common questions we could tackle in another episode. But we're kind of coming up on time. Hopefully that was helpful. Love having you on the show, Matt. We're going to get you involved more as we address some of these as well. Maybe we'll get all 3 of us on the show at some point.
That'll be interesting.
Yeah, I don't know. The audio engineers might have to deal with our fighting and cackling to get on the mic, but that's their problem, I guess. So yeah, this has been fun to tackle some of these. That's what we have for today. I thanks for spending the valuable time with us. If you know anybody who needs guidance like this, just click the share button and share it with them directly. If you're a fan of the show, give us a like, give us a review. It really does help us out. And, if you just want to learn more about the team behind MedTech Wealth Advisor, visit our website. Our group's website is perspective6group.com. It's perspective, the number 6 and group.com, or you can call me directly, 952-225-0333. And until next time, remember, financial freedom takes a lot more than money. So find your purpose, make a plan to live your life well. If you need any guidance, we're here for you. Take care of each other out there.